This is a video review on valuing perpetual inventory utilizing LIFO valuation. We're also going to take a few minutes to talk about the concept of what a LIFO reserve is and what you may encounter on the exam. First of all, let's go to and take a look at our LIFO inventory record. Our perpetual inventory record, and you can see that the perpetual inventory record is like the other ones that have been demonstrated in other videos. Again, we have a date, transaction, what type of transaction, the number of units involved, the cost per unit, the cost of that particular transaction, the units on hand, the cost layer, and the inventory balance. In this case, we have a beginning balance of 60 units on hand, and we have this concept we call a cost layer, and it's called layer 0. In other words, our beginning balance, $20 cost per unit times 60 units equals $1,200. So the inventory value in this perpetual inventory system is $1,200. This layer 0 represents the original cost layer. Now, just like we did with FIFO, we build cost layers when we purchase something, but when we actually sell something, in FIFO we use the first costs that we had built up first. In the case of LIFO, we use the last costs that we built up first. So that's the difference between the two. So let's go ahead and start with our first purchase. Date number 1, we purchased 20 units. And if we take a look at this, the cost is $32. We purchased them for $32 a unit. So if we value the transaction, the purchase, it's 20 units times $32, and that creates what we call a layer 1 cost of $640. Now, we'll talk about that layers in just a second, but right now the cost of that transaction is $640. So we would have a credit to, let's say, accounts payable or cash, and a debit to inventory for $640. Now also, we started out with 60 units on hand. To that we add those 20 units, so 60 plus 20, now we have 80 units on hand. We also now add what we call a cost layer, and this happens to be layer 1. The reason we call it layer 1, we want to differentiate it from layer 0. Layer 1 says our purchase basically was 20 units at $32 per unit. So the layer 1 is worth $640. So if you take a look and you value both of the layers, layer 0 totals $1,200, and layer 1 now has a value of $640, which means that the inventory balance for this perpetual inventory record is now $1,840. Okay, now let's go on to the sale, and we're selling 70 units. And we're going to cost out our transaction, and the costing is going to be a little different in that we're costing based upon layers. The first thing we do is we take, to cost out our layers, or to cost out the transaction, we take the latest layer that we added, we cost that out, or we liquidate that first. Now in this case, layer 1 was the last layer that we put in, so we liquidate that first. So in this case, we had 32 units at $20 a unit. So the most we can liquidate from that layer is 20 units times $32. So the part of the cost of that transaction now is $640, and it shows down here 20 of the units sold are liquidated from the $32 cost layer, which by the way is the entire layer, since that was all 20 units. So now what we have to do is we still have 50 more units that we have to cost. We do that by going back to the next recent cost layer. In this case, it's going to be layer 0. And in the case of layer 0, we know there are 60 units in that layer at $20 each. So we've already used up 20 units, so now we have to use up 50 units of those 60 units. So here to add to the cost of our transaction, we use up 50 units from cost layer 0 times $20 per unit from that cost layer value equals $1,000. So if we add those two together, the total is $1,640. So that's the cost of the perpetual inventory when we sell the inventory, and the journal entry would be a credit to inventory for $1,640 and a debit to cost of goods sold for $1,640. Sorry, I went on a little bit too quickly. So now we have, in terms of units on hand, we started out with 80, we sold 70, now we have 10 units on hand, and that agrees to our layer 0 cost layer, where we have 10 units remaining at $20 per unit, meaning the value of our inventory now is $200. Okay, now we go on to transaction number 3. In this case, it's the purchase of some additional units, and there was 30 units at $14. So to value the cost of the transaction, it's 30 units times $14 equals $420. So we're going to add that to our inventory value, credit accounts payable for $420 and debit inventory for $420. You're also going to see that units on hand, we started out with 10 units, we add 30 units, so now we have 40 units on hand. You'll also notice that we add another cost layer, and I'm calling this layer 2 to differentiate it from the first layer that we liquidated. But this happens to be now our latest cost layer, and it's basically the $14 cost times the 30 units that we purchased equals $420. So now we value both layer 0 and layer 2, and they total up to be $620. Okay, now we're going to go on to date number 4, where we show a sale, and in this case we're selling 20 units. So the question is what is the cost of the transaction? And when we take a look here, basically we sold 20 of the units that were sold are liquidated from that $14 cost layer, and that's going to still leave 10 units remaining in that layer 2 cost layer. So we didn't use any of layer 0 in the transaction. We actually used 20 units of layer 2. So in this case, it would be our cost of our transaction would be 20 units of layer 2 times $14 cost at layer 2, and our cost would be $280, and our journal entry would be credit inventory for $280 and debit cost of goods sold for $280. And again, we started out with 40 units, we sold 20, that means we have 20 units left over. And now if we take a look here, now we have two cost layers. Layer 0, where we had $20 cost per units times the 10 units. We haven't touched that layer, so that equals $200. We have 10 units remaining in layer 2 with cost of $14 per unit, so that's going to equal $140. So we add the two together, and they total to $340. Now let's take a look at a multiple choice question, and again this could be a simulation if they so set it up that way. But here we have the following information pertains to the inventory noted on a company's perpetual inventory system, and you have these various transactions and the costs and so forth. Under the LIFO method, what is the amount of inventory that should be reported at the end of the month? So we're looking for the inventory balance. So go ahead, review the question, stop the video. Okay, in this case, the answer to number 1, under the LIFO method, what is the amount of inventory that should be reported at the end of the month? And the answer is B, $2,700. And here's how we create that particular transaction trail. We start off with our beginning inventory, and we know that it's 1,000 units at $1 a unit. On day 5, we purchased 600 units at $3 a unit. The transaction cost in this case was $1,800 for the purchase. So if we combine these two, if we combine our beginning inventory and purchase together, we had a total amount of units on hand equal to 1,000 plus 600 equals 1,600. And now we take a look at the LIFO layers that have been created based upon these two transactions. we have the beginning inventory layer of 1,000 units at $1 each for $1,000, and we have the day 5 layer now from that purchase of 600 units at $3 each for $1,800. So the value of our LIFO inventory at this point was $2,800. Now on day 26, we made a purchase, and in this case, or sorry, we made a sale. And in this case, the sale was for 900 units. Now, if I go through the units on hand first, what I can say is 1,600 units times, or 1,600 units minus 900 units sold, we now have 700 units left on hand. Now we have to cost out those transactions based upon our LIFO cost layers. So the first thing is we cost out LIFO, the LIFO, the latest cost in first. So in this case, we had the day 5 layer of 600 units. So in this case, we take 600 units times $3. That's a cost in that LIFO layer. That's the day 5 LIFO layer. So that's going to equal $1,800. But we are only able to liquidate 600 units since there's only 600 units in that layer. That means we're going to have to liquidate another 300 units. That's going to come from the previous layer, which in this case is a beginning inventory layer of 1,000 at $1. So in this case, we liquidate 300 units from that layer times a dollar value at that layer. So which is our beginning inventory layer. So that would be $300. So the transaction cost itself is, when we sell something, that would be $2,100 cost of goods sold. And now if we take a look at our LIFO layers, we have 0 left in our day 5 layer. So that layer is basically liquidated. It's gone. And we have 700 units left in our beginning inventory layer at $1 a unit. So that equals $700. So at this point in time, the inventory value is worth $700. Okay, now we go on to the purchase on day 28, and the value of that transaction was 400 units at $5 a unit. The transaction value was $2,000, and again, with accumulated units, the number would be 700 units plus the 400 units that we bought equals 1,100 units. Now we're going to add that $2,000 as the next LIFO layer to when we stack our costs with LIFO layers. So we have our beginning inventory layer that is still $700, valued at $1 each for $700. And now we have a day 28 layer of 400 units at $5 each equals 2,000. So the inventory value based upon our LIFO layer valuation is $2,700, and that's how we get to the answer B, $2,700. Many entities are going to use LIFO for tax purposes because LIFO, the characteristic of LIFO in a period of rising prices, LIFO will produce basically the highest cost of sales. And if you produce the highest cost of sales from a taxable income point of view, you're also going to minimize your net income. So a lot of companies utilize LIFO for IRS for tax purposes. Now, there's an IRS regulation that requires LIFO to be used for financial reporting if it's used on the tax return. In a number of cases, a lot of companies use a different inventory costing method for their own internal purposes. And in that case, then, they have to convert their inventory valuation to a LIFO valuation for reporting purposes, because again, if they use LIFO for tax purposes, they also have to use it for financial reporting purposes. And to adjust inventory to LIFO, what happens is the company creates an allowance, and many times it's called a LIFO reserve. And the LIFO reserve is a contra to inventory, and it creates the approximation of LIFO if we were actually to keep the books on a LIFO basis. Now, Let's take a look at this question. Acme uses the average cost inventory for internal reporting purposes and LIFO for financial reporting. At the end of the year, the value of the inventory was $455,000 at average cost, and if they valued that same inventory at LIFO, the inventory would have been valued at $350,000. Now, the balance in the LIFO reserve at the end of the year was $50,000. What entry should Acme record to adjust from average cost to LIFO at year end? So in this case, what we do need to understand is how the LIFO reserve account, it's not asking you to do any calculation other than realize the LIFO reserve account has to be adjusted. So in this case, we have to choose the correct accounting entry. And again, remember the LIFO reserve is a contra account. So the LIFO reserve itself basically reduces the value of inventory and increases cost of goods sold. So go ahead and, again, this is a bit of a learning slide. Go ahead and see if you can discern the answer. Go ahead and stop the video. And again, the question was, what entry should Drew record to adjust from average cost to the LIFO reserve, knowing that we already had a balance in our LIFO reserve of $50,000? And the answer in this case is A, $55,000. Again, the LIFO reserve account is an allowance that adjusts the inventory balance stated according to the method used for internal reporting purposes to the LIFO amount approximate for external reporting and also then probably for tax purposes. Now, the computation here is fairly simple. The value of inventory at average cost was $455,000. Now, if we were to value the inventory at LIFO, and again, that would be done in a separate calculation, the inventory value would have been $350,000. So in order to get the LIFO, the average inventory value down to the LIFO reserve amount, we're going to have to basically subtract out $105,000. In other words, that amount would have to be in the reserve. Okay, now we already have the present reserve amount of $50,000, so we're already part of the way there. So the additional reserve that is needed would be $55,000, and that's how we come up with the journal entry. If we have to increase our LIFO reserve, that increases cost of goods sold. If for some reason we decrease the LIFO reserve, that will be a credit to cost of goods sold. So that's the answer for number 2 with LIFO reserve type of with a LIFO reserve type of an adjustment. Okay, and that ends the review for LIFO valuation under perpetual inventory and an introduction to LIFO reserve.